I am still bearish on gold. I still think it's going lower. If you're a bull right now on gold, you want to see this upper parallel attack, and that would be around 5,000. We could break back above 5,000. That would be the breakout, and you probably go revisit your all-time highs. I do worry that if we do get a bigger stock market flush, we'll get down to 3,500 on gold. But again, that would be we'd need to see something like 20% drawdown in the NASDAQ probably to get us there. The biggest thing that strikes me is you do see the gold kind of inversely moving in with the bond yield there. But the more important thing to me is what is the bond market telling us? Because if you look at the stock market's telling us everything is perfect. There's never going to be a problem again in the world. And if you look at the bond market's hanging eerily near that 4.5% yield on the 10-year.
The FOMC kept rates unchanged this week, Gareth. There were 4 dissents, 8, 4, and 4 dissents. This is from Kalshi Prediction Market. Traders are placing an 18% chance of recession this year. And in fact,
the massive stimulus engine is going to run. And looking at everything going on, you have to say that, okay, this is probably why we haven't been in a recession yet.
You're short the S&P right now. By extension, would you also be short gold and Bitcoin, given how both have seemingly performed as risk assets in the last couple of months? I'll let you start with gold. Yeah, you have on the chart.
Yep. And so the first thing is gold's already significantly off of its highs. I am still bearish on gold. I still think it's going lower, but I'm still holding my long-term holdings, and then I'm basically neutral on gold in terms of swing trading. And so to answer your question is, if we were closer to an extended move, then I would be much more on the short side. I'm more bearish by just bias, meaning I'm not a buyer here. But if we pull back to key levels, I have a key level at 3,900 right here, and then 3,500. That would be the level where I would really be eyeing buying more long-term holdings. And I guess to put it in perspective is, even though I think there's downside on gold in the near term, because like you said, it's a risk asset, right? It's trading like a risk asset like silver as well. I still think 5 years from now, gold is much, much higher. And until I see some fiscal responsibility in the government, I'm going to continue to want to buy gold on big pullbacks, and silver, to be fair.
Okay, can you walk us through some key levels, Gareth, for gold right now?
Absolutely.
Gold investors, listen carefully. This could be a trap. While most people still believe gold is in a strong bull market, top trader Gareth Soloway warns the opposite may be unfolding. Prices are already pulling back, and if key levels break, we could see a much deeper drop before the real opportunity begins. Even more concerning, gold is no longer acting like a safe haven. It's behaving like a risk asset tied to stocks, bond yields, and liquidity. So the big question is gold about to flush lower before the next massive rally?
So if you're a bull right now on gold, you want to see this upper parallel attacked, and that would be around 5,000. If we could break back above 5,000, that would be the breakout, and you probably go revisit your all-time highs and maybe even go higher. On the downside, notice the low end of the parallel here is equal right to this low pivot. So this 3,900 zone right here would be your first major support. So you have your resistance and support. And you can see it's kind of in the middle of those two. And that's why I'm not really in a trade in it right now, is because it's not a great risk reward assessment in the short term. I mean, long-term holdings are long-term holdings, but short-term swing trading, I'm just neutral on this. I do worry that if we do get a bigger stock market flush, we'll get down to 3,500 on gold. But again, that would be we'd need to see something like 20% drawdown in the NASDAQ probably to get us there.
Bottom line is, are you trading gold like it's a risk asset?
Yeah. I mean, you have to right now. That's what it's proven to be. And I truly believe gold will bottom out when it flushes out all the weak hands that bought it because they thought it was easy money, risk on trade to the upside when it was back in this period. And so, I know you've covered gold since your Kitco days, way long ago, right? And so you know that usually gold doesn't behave like this. And so it morphed into something it's not normally, it doesn't react normally that way. And I'm a true believer that it's going to have to be so boring and so bad that all of those weak hands have to get out, and it's going to leave the hardcore buyers, the hardcore followers, and that's when it'll start making its next bull move.
Another thing to point out, I don't know if you can do this, but if you overlay the gold price with the U.S. 10-year yield, you'll notice a very close inverse relationship right now. Okay, there we go. And this is important because according to economists and and traders and investors like yourself, inflation expectations, while they've been going down in the market, still remain top of mind for a lot of investors and the Federal Reserve. If inflation goes up and the 10-year yield continues to track inflation, we're looking at a scenario in which yields go up, which drives precious metals down. One could say coincidence, but let's just go over that one more time. New price scale. Yeah, here we go. 10-year yield versus the gold price. And if you're somebody who believes that bond vigilantes is going to kick in and sell off bonds and push up yields if the Federal Reserve doesn't change anything this year, then you're probably looking at a very bearish scenario for gold if you assume this relationship holds. Take a look at the screen, Gareth, and get your comment here.
Yeah, and I think you have to, and the biggest thing that strikes me, number one, is you do see the gold kind of inversely moving in with the bond yield there. But the more important thing to me is, what is the bond market telling us? Because if you look at the stock market's telling us everything is perfect. There's never going to be a problem again in the world. And if you look at the bond market's hanging eerily near that 4.5% yield on the 10-year. And that is not where people would say is the bond market saying the all clear. And I do just want to mention to people is that the stock market can kind of get carried away with itself. A lot of retail money, for instance, today this is the first of the month, so you have retail money coming in the market after payday, driving markets up today. The NASDAQ piercing 25,000, like we said. But I think you also have to just be aware that the bond market is telling us there needs to be a caution flag on this move. Most investors are ignoring it.
The FOMC kept rates unchanged this week, Gareth. There were 4 dissents, 8, 4, and 4 dissents. This is the most number of dissents since 1992. And importantly, 3 of the 4 dissents, except for Stephen Myron, 3 of those dissents came from governors who felt that the Fed shouldn't even be hinting at easy. It's not that they dissented or voted no to the fact that they kept rates unchanged. They voted no to the fact that certain statements made by Powell and the other governors hinted that they would ease if data showed that they should ease. And I'm not sure how you would take that as a trader, given how hawkish that sounds.
Yeah. So the way I look at it is this, is that the Fed with Jerome Powell leaving the helm, and he's going to stay on as a governor, right? So we know that he's going to be there anchoring. And I actually think that's a positive for the market, because the market is craving stability with the Federal Reserve and that independence. And with Jerome Powell saying he was going to stay on, it kind of signals that, okay, Kevin Warsh can't come in and just do whatever Donald Trump, the president, says that he needs to do. There's going to be pushback. And I think the governors being as hawkish as they were is also sending that signal to Kevin Warsh that, hey, you can't come in here and just say, hey, we're going to cut rates. We have a vote. And remember, people out there watching, the chairman does not get to decide. It's a voting member that gets to decide. So the votes have to accrue. And that, again, I think is something that, number one, it pushes back on that independence. It gives the Fed more looks at being independent, but it also shows that, all right, we're going to push back and make sure that things are done right here.
Okay. Are you concerned about really high inflation, or do you think this is only temporary?
I'm concerned that the spike in inflation is high because of oil, right? So we're definitely going to see this follow through. I mean, it was one thing if this oil spike had been a week or two or even a month. It's now going into its 3rd month, right? We've been through 2 months. We're into the 3rd now. This is going to have long-lasting implications because the producers are not going to eat this cost constantly. The other aspect, and I think eventually that spike will come back in, but my worry is that the long-term inflation is going to stick around. And we already saw this, right? We saw that even after everything and all the hikes from 2022, inflation came back to about 2.7%, and it's now starting to go up. We didn't get back to 2%. And the issue remains is that as long as the U.S. government is spending like a drunken sailor with $1 trillion in additional debt being spent basically every quarter, it's going to put more and more emphasis on printing money to eventually deal with that debt. And that's going to create a long-term sustainable inflation bug that probably keeps inflation much, much higher than 2%, which is where everybody wants it.
So if we're going to get a huge spike in inflation from the oil price, maybe it doesn't stay very long, but there is a spike. Would you call this year, 2026, a year of inflation hedging?
Yeah, I mean, to some extent. I mean, I think the big spike, you would call it transitory, right? I mean, that word is so
Sure.
charged these days. But, that spike is because of oil directly. Once oil eventually comes back down to, let's say, 70 or $60 a barrel, which it will, especially with the midterms lurking, there's this pressure on the president to get some resolution in there to bring these oil prices down.
Right now, the technical picture for gold is very clear. On the upside, bulls need a breakout above $5,000. That's the key level that could send gold back toward all-time highs. But until that happens, the trend remains fragile and possibly bearish. On the downside, there are two critical levels to watch. First, $3,900, which acts as initial support, and then a deeper level around $3,500, a zone where real long-term buyers may finally step in. But here's where it gets interesting. Gold is currently trading like a risk asset, not a safe haven. That means if the stock market drops hard, especially if the NASDAQ Composite falls by around 20%, gold could get dragged down with it. And the bond market is flashing warning signs. The US 10-year yield is hovering near 4.5%, which historically puts pressure on gold. Why? Because gold tends to move inversely to yields. If yields rise further, gold, and even silver, could face more downside. Meanwhile, the stock market is sending the opposite message, acting like everything is fine. That kind of divergence doesn't last. Either stocks are wrong or bonds are. And historically, when this gap closes, it happens fast and violently. Now add in the Federal Reserve. Despite holding rates steady, there's been the highest level of internal disagreement since 1992. That signals something important. Rate cuts may not come as easily as markets expect. And if rates stay higher for longer, that's more pressure on gold in the short term. But zoom out, and the long-term picture flips. Persistent government spending, rising debt, and structural inflation around 3 to 4% create a powerful tailwind for gold over time. So what's the real takeaway? This current range, between $3,900 and $5,000, isn't an opportunity. It's a trap zone, a place where investors get chopped up, while the market prepares for its next major move. The real bottom likely comes only after a deeper flush, when weak hands are forced out and sentiment turns negative.
But once you get that down, you still have the issue of what's going on even prior to those oil price spikes. And that's where I think you get this longer term high end inflation, probably between 3 and 4%, which again, for the average American who's already struggling, that's a huge deal. 3 to 4% prices going up every year across the board. And it's going to be unsustainable as well. But the government, again, is showing no signs of cutting back on spending. In fact, they're spending even quicker now.
Before we move on to your outlook for individual securities and stocks, let's get your outlook on the economy. This is from Kalshi Prediction Market. Traders are placing an 18% chances of recession this year. And in fact, the chances have gone down since the Iran war broke out, not up. It seems that traders are placing odds that some sort of resolution will be met this year. But anyway, recession odds this year are pretty low as of today. Gareth, do you, first of all, agree with this kind of outlook, this prediction? And second, how would you trade on this?
Yeah, and so I do partially agree with this, and I'll tell you guys this is that basically we are in an economy where as long as these mega caps are willing to spend 100 to 200 billion dollars every year, the massive stimulus engine is going to run. And looking at everything going on, you have to say that okay, this is probably why we haven't been in a recession yet, because there's so much capex being spent on the AI build out, data centers, picks and shovels, all the infrastructure, right? It really does filter through a large portion of the economy. Now, there's other parts of the economy that many would argue are already in a recession, but at least on the baseline of what will actually be classified as a recession, at most it would be at the very end of the year, but I would say you push it out more towards 2027 at this point. And the real kicker is going to be, when do these institutions, these big players like Meta and Amazon and Google and Microsoft, when do they start pulling back on their spend? That's going to be when the recession hits, right? Once they start, they let's say they go from 200 billion each or 150 billion each, even to 100. That's a massive amount of sucking out of the economy of money, and that's when you'll get in that recession.
Jerome Powell himself even said at the FOMC meeting that one of the reporters asked him how he would assess the economy, and he mentioned that data centers and AI capex have been major drivers of the economy so far. So that's a view shared by the Federal Reserve itself.
At least in the short term, I am long natural gas. Again, just as a trade, I'm looking for a potential breakout here above this 288 level. I like this short-term downtrend. We broke above it. I do think there's a catch-up trade between oil. If oil comes in, you may see natural gas start to get some money flow in that rotation of capital. Historically, that has somewhat happened with the two energy sources. I also think that the data centers are at a point where the nuclear energy is not ready to power them, and oil is much more expensive relative to natural gas. And so you have to wonder if maybe natural gas would be a potential energy source for these data centers that need so much energy. And so there are some at these levels on natural gas. It's one of the few assets that I'm willing to step up and put some money behind. Aside from that, I'm just patiently waiting, a lot of cash on the sidelines or shorts on the stock market, and just waiting for these markets to kind of come back in until I can start going long gold, going long silver, and stocks again.
By the way, which is going to fall first, stocks or Bitcoin?
Chicken or the egg, huh? I would say that the stock market will drop more initially than Bitcoin because Bitcoin already has a lot of money that's exited. But I think if the stock market keeps falling, Bitcoin suddenly starts to panic, or investors in Bitcoin will panic and it'll play catch up. But I would say the stock market's more due. Like if you ask me right now, would you rather be long Bitcoin at this price or the stock market overall? I would choose Bitcoin. Bitcoin already discounted significantly. The market is, I mean, literally case in point, so many signals of a dot-com bubble. I want to show you guys one more chart here because I think this really explains it. Let's go back to the NASDAQ Composite. And one of the things, and some people in the comments say this, they're like, oh, the markets will never go down because we have so much liquidity in the market. Okay, well, let's test that theory. Let's divide the NASDAQ by M2 money supply. All right, when we do that, look at what we get here. If we go to our monthly chart, you actually have the NASDAQ slightly above the dot-com high when you divide it by M2 money supply. And I think that's telling. I think people don't recognize that, is that you've now gotten to a place where it is massive in terms of the valuation of the NASDAQ relative to money supply.
My personal assessment is that, look, I agree. Like, both look a little frothy, but Bitcoin, the stock market's frothy. Bitcoin probably has those reasons for why it's off its all-time highs by a lot, and it's down on the year versus gold and stocks, which are both up. Now, the point is sentiment. It's low, and historically, after a bull cycle has ended, which is 18 months ago, roughly, sentiment has been, in my experience, a pretty good gauge of when the bottom is. And I'm not calling up this bottom. I'm just saying this feels completely 180 from where we were 1 year ago, when it seems like people were scrambling to throw their money at Bitcoin at about $100,000 and above. I personally bought a few more, not a few more, but a bit more Bitcoins at around $100,000. I tend to buy at the top, which is why I'm not a professional trader. Use me as a contrary indicator, guys. And right now, I feel like no one's talking about getting into Bitcoin.
You're right.
So take that as a signal,
and
if you will.
Like I just said, I think the sentiment is a great indicator. And I would also say this is, let's say the NASDAQ just keeps going up. At some point, risk money will go back to Bitcoin and propel it up, probably as a catch-up trade. And so you could be right in that respect too, is way too much bearish sentiment. If the NASDAQ, and maybe the key is this, can the NASDAQ stay strong enough to get eventually to lift Bitcoin? And I think once Bitcoin breaks out, it goes very, very quickly.
So here's the bottom line. Short term, gold may still have downside risk. But long term, the bullish case is far from over. The key is patience, because the biggest gains often come after the most painful shakeouts. If you want more breakdowns like this on gold, silver, and the global economy, make sure to subscribe and stay ahead of what the market is really signaling. Because in times like these, understanding the cycle is everything.